Japan's currency is falling. The rise and fall of the yen. Japan's yen, once a symbol of economic strength and stability, has experienced significant fluctuations over the years. The yen's value has seen both remarkable highs and concerning lows, reflecting the complex interplay of global economic forces, domestic policies, and shifts in investor sentiment. This essay explores the rise and fall of the yen, analyzing the factors that have influenced its value over time and the broader implications for Japan's economy and global financial markets. The rise of the yen, post-war economic boom. The rise of the yen can be traced back to Japan's post-World War II economic miracle, a period of rapid industrialization and economic growth that transformed the country into one of the world's leading economies. During the 1950s and 1960s, Japan's export-driven growth model, supported by a strong manufacturing sector, led to a steady appreciation of the yen. The yen's value was initially pegged to the US dollar under the Bretton Woods system at a fixed exchange rate of 360 yen to the dollar. However, the collapse of the Bretton Woods system in the early 1970s marked the beginning of a new era for the yen. In 1971, the US abandoned the gold standard, leading to the floating of major currencies, including the yen. Freed from the fixed exchange rate, the yen began to appreciate, reflecting Japan's growing trade surplus and its position as a global economic powerhouse. By the mid-1980s, the yen had strengthened significantly, peaking at around 240 yen to the dollar. The Plaza Accord and the yen surge. One of the most significant events in the yen's history was the Plaza Accord of 1985, an agreement between 5 major economies, the United States, Japan, West Germany, France, and the United Kingdom, to depreciate the US dollar relative to other currencies, particularly the yen and the German mark. The aim was to address global trade imbalances, particularly the large U.S. trade deficit. The Plaza Accord triggered a rapid appreciation of the yen, which more than doubled in value against the dollar over the next 2 years, reaching a peak of around 120 yen to the dollar by 1988. While the stronger yen helped reduce Japan's trade surplus, it also had significant economic consequences. The rapid appreciation led to a deflationary environment in Japan as the cost of exports increased, making Japanese goods less competitive on the global market. This period of yen strength also contributed to the formation of an asset bubble in Japan's real estate and stock markets. The lost decade and yen stability. The bursting of Japan's asset bubble in the early 1990s marked the beginning of what is often referred to as the lost decade, a period of economic stagnation and deflation that lasted for much of the 1990s and early 2010s. During this time, the yen remained relatively strong, hovering around 100-120 yen to the dollar. However, the economic challenges facing Japan, including a banking crisis and persistent deflation, limited the country's growth prospects. To combat deflation and stimulate the economy, the Bank of Japan implemented a series of monetary easing measures, including lowering interest rates to near zero levels and eventually adopting quantitative easing policies. These measures, while aimed at reviving the economy, also contributed to a stable yet strong yen, as low interest rates made the yen an attractive currency for carry trades, where investors borrow in yen to invest in higher-yielding assets elsewhere. The global financial crisis and yen appreciation. The global financial crisis of 2008 had a profound impact on currency markets, including the yen. As a safe haven currency, the yen saw significant appreciation during the crisis as investors sought refuge in perceived safer assets. At its peak, the yen reached a high of 76 yen to the dollar in 2011, the strongest level since the post-Plaza Accord era. This appreciation posed challenges for Japan's export-oriented economy, as a strong yen made Japanese goods more expensive for foreign buyers. In response, the BOJ and the Japanese government took several measures to curb the yen's strength, including direct intervention in currency markets and further monetary easing. However, these efforts had limited success in weakening the yen, and Japan continued to struggle with deflation and sluggish economic growth. The Abenomics era, yen depreciation and economic revival. The election of Shinzo Abe as Prime Minister in 2012 marked a turning point in Japan's economic policy with the introduction of Abenomics, a set of policies aimed at reviving Japan's economy through monetary easing, fiscal stimulus, and structural reforms. A key component of Abenomics was aggressive monetary easing by the BOJ, including doubling down on QE and introducing negative interest rates. These policies led to a significant depreciation of the yen, which fell from around 80 yen to the dollar in 2012 to over 120 yen to the dollar by 2015. The weaker yen provided a boost to Japan's exporters, helping to lift corporate profits and stock prices. However, the effects of yen depreciation on the broader economy were mixed. While it supported export growth, it also led to higher import costs, particularly for energy, given Japan's reliance on imported fossil fuels after the 2011 Fukushima nuclear disaster. Recent trends, yen weakness and global uncertainty. In recent years, the yen has experienced renewed weakness, driven by a combination of factors, including the BOJ's continued ultra-loose monetary policy, global economic uncertainty, and shifts in investor sentiment. As of 2024, the yen has depreciated to levels not seen in decades, with the exchange rate reaching around 150 yen to the dollar. Several factors have contributed to the yen's recent weakness. First, the BOJ has maintained its commitment to ultra-loose monetary policy even as other major central banks, such as the U.S. Federal Reserve, have begun tightening policy in response to rising inflation. The resulting interest rate differentials have made the yen less attractive to investors, leading to capital outflows and further depreciation. Second, global economic uncertainty, including concerns about slowing growth in China, Japan's largest trading partner, and geopolitical tensions, has added to downward pressure on the yen. While the yen is traditionally seen as a safe haven currency, its role has diminished somewhat in recent years as investors have increasingly turned to the US dollar as the preferred safe haven. Finally, structural challenges within Japan's economy, including an aging population, low productivity growth, and high levels of public debt, have contributed to a weaker yen. These challenges have raised concerns about Japan's long-term economic prospects and have led to increased speculation against the yen. The implications of a falling yen. The falling yen has significant implications for Japan's economy and its role in the global financial system. On the one hand, a weaker yen can be beneficial for Japan's exporters as it makes Japanese goods more competitive on the global market. This can help boost corporate profits, support economic growth, and improve Japan's trade balance. However, there are also significant risks associated with a falling yen. Higher import costs, particularly for essential goods like energy and food, can lead to inflationary pressures and erode consumers' purchasing power. This is particularly concerning for a country like Japan, which relies heavily on imports for its energy needs. Moreover, a prolonged period of yen weakness could undermine investor confidence in Japan's economy and lead to increased capital flight. This could put additional pressure on the yen and exacerbate Japan's economic challenges, particularly if it leads to higher borrowing costs for the government and corporations. Future prospects. Can the yen rebound? Looking ahead, the future of the yen remains uncertain as it is influenced by a complex interplay of domestic and global factors. On the domestic front, the trajectory of the yen will largely depend on the BOJ's monetary policy and the effectiveness of Japan's economic reforms. If the BOJ begins to normalize policy and raise interest rates, the yen could see some appreciation. However, this would need to be balanced against the risk of stifling economic growth, particularly if inflation remains subdued. Globally, the yen's future will also be shaped by developments in major economies, particularly the US and China, and the broader geopolitical environment. If global economic conditions deteriorate, the yen could regain some of its safe haven appeal, leading to renewed appreciation. Conversely, continued strength in the US dollar and rising interest rates in other major economies could keep the yen under pressure. The rise and fall of the yen reflect the broader economic and financial dynamics that have shaped Japan's economy over the past several decades. From its post-war ascent to its recent decline, the yen's value has been a barometer of Japan's economic health and its position in the global financial system. As Japan continues to navigate the challenges of a falling currency, the yen's future will depend on a delicate balance of domestic policy decisions and global economic developments. Whether the yen will rebound or continue to weaken remains uncertain, but its trajectory will undoubtedly have significant implications for Japan and the world.